Welcome back to Vantage. We want to start 2022 with something a little bit different. And I'm really pleased that we got the current manager on to the program. We're focusing on Indian equities. It's a market I have to tell you that I don't know that much about. I'm always keen to learn. There's some really exciting mid-cap plays that we're going to discover. Let's take a look. So welcome back to Vantage, everyone. We're doing something a little bit different this time. We are talking to Arun Chulani of First Water, who looks at the Indian equities market. Now, Arun, I am someone of Indian descent, but I've spent my life looking at developed markets, and probably, I'll confess, I don't know the Indian equity markets particularly well. I'd love you to give us a thumbnail sketch before we get into the interview of the market, the big names in the market, what's driving the Indian economy.
Sure. Well, thank you so much for having me. As you rightly mentioned, we at First Water look at Indian equities. And effectively, India today is the 5th largest economy in the world. By 2031, it's predicted to be the 3rd largest. So it's pretty decently placed. Obviously, we have a huge population, around 1.3 billion people. And that is one of the main factors driving the economy, the huge domestic engine that we have within. Our indices are called the Sensex and Nifty. They are, until 1991, we were very much a domestic industry. There's a lot of protectionism around India's economy, high tariffs. So we had a lot of industries grow within. So these are the real dominant players. So like Japan and Korea had their Zaibatsus and Chaebols. We have our maharajas, let's say, the industrial maharajas, like Tata, Jindal, Ambani's, Adani. So these guys are the big players within the space, but that doesn't really mean that they dominate everything, but they do have, let's say, the bigger industries under their banner. And that's essentially it.
Okay, and I mean, when we get into this, you really focus not at the top end of the market, but underneath at some of the smaller players where you're hunting value. But we'll get into that. Perhaps just give us a quick prognosis of the outlook for the Indian equities, the Indian macro outlook.
Okay, so I think every big economy, industrial or not, has its time in the sun. So if you look at the turn of the last century, Britain was the leading economy around the world. It passed on the baton of growth to America, which passed on to Japan, West Germany, and China's had its day in the sun. But that in itself, and China's done a fantastic job, is pulled a massive amount of people out of poverty. So back in the 90s, India and China were neck to neck with capita GDP. Around $1,000 or $2,000. It wasn't very significant, but China is now around $12,000. So what they've done is an economic miracle, whereas India today is still at $2,500. But effectively, that is also part of the slowdown, because China will now become uncompetitive on its industrial fronts, and it's also has to look at it from an upscaling perspective. And that is where India's golden decade, we hope, will come in play, because you've seen COVID. Now people are looking at China plus one policy that is going to benefit a country like India. You've seen, like I mentioned, the per capita GDP. So now we're a bit more competitive, and the government itself is really pushing a number of sectors. For instance, textiles, chemicals, steel. These are India's forte areas, and this is an area where, if you read the 14th five-year plan for China, is where they are scaling down or looking to become more environmentally friendly and upscale, whether it's tech or build in their own domestic consumption economy. So these are the areas that India will really take advantage of. We are the number 2 in steel, we're the number 6 in the world in chemicals, and we have some really world-class players. And yeah, I mean, and of course, not to mention our tech. Our tech exports more than Saudi Arabia's crude oil exports, which is something most people won't realize. But this, since the early 90s, has come from nowhere and been an industry of its own. So yeah, I mean, there's a whole number of players. Plus, you've got the consumption story. So effectively, as I mentioned, today we have $2,500 per GDP, and let's say in 5 years it's predicted to be 5,000, for instance. But most people say that means your consumption is doubled, but that's actually not the case, because your fixed costs are around 2,000. Once you've done your housing, your schooling, and so on, your discretionary costs are now $500. But that $500 is now going to spin into $2,500. So it's actually going up 4x. So whereas that also is not only from the, let's say, the starting class, but that also means the middle class is also going to have that kind of advantage. So from aspiring to have a car, a house, a second house, all these things are going to flow through into the economy, whether it's affordable housing, whether it's automation, computers, FMCG. This India itself has this domestic economy which will drive its essentially its growth. So whether it goes at 5 or 8% is really not the issue here, but it's the overriding tailwinds that will push this.
Yeah. So the big picture is, driven by a competitive position in industrials. That's sort of feeding GDP growth. You see the consumer benefit. And I love these interviews because you always learn something new. I didn't know that India was exporting so much in tech. So that's something I'm going to put a pin in. So now look, I've known you for a long time. You weren't always a fund manager. Why don't you talk us a little bit about your background and how you come to be managing money?
Sure. So when I graduated from the LSE, I always wanted to actually go into equities, but as luck would have it, 1998, I'm sure there was some crisis going on at the time, and I went into Arthur Andersen and became a chartered accountant, which is a great foundation, but not exactly what I wanted to do. Then when I finished my CA, as luck would have it, you had the dot-com bubble of 2001 crash down on me. So then I went into Lloyd's TSB. So I guess it's just been a meandering way of how I find myself in Indian equities. And I think even until I was 35, I wasn't in the place I wanted to be. I'd been in corporate finance, I'd been in treasury, a whole bunch of places. And, but anyways, I think ambition is both a curse as well as a blessing. And somehow I still wanted to get in, and I wasn't willing to give up. And I got a great opportunity when I was in Ernst & Young. I was in corporate finance, restructuring within the region, within Dubai, but I still wanted to do something more investment focused. And I got this great opportunity in a PE house doing industrial private equity, and is working with some great people, the ex KPC CEO, the ex oil minister for Kuwait, and yet, it's a great experience. I was learning about petrochems, chemicals, ONG, a whole bunch of different factors over there. And that's how I actually started. But how I got into First Water is I met an old, let's say, family friend. And I heard he did pretty well. I didn't really know how well. And then he says, Arun, what are you doing? And I said, I'm doing PE and blah, blah, blah. And he said, whatever you're doing, probably not very good. And this is how I look at things. So it was just like an eye-opening kind of opportunity that I got, because he said, this is how I value, these are the sectors I look at, and this is what I do. And I think we've all been conditioned when we leave university or when we're working in banks. Initially, we all want to be the next big thing, the next hot portfolio manager. But at the end of the day, we join a franchise and we become, let's say, semi-sales guys. And then if JP Morgan says this stock is going up 30% buy, that's what we've been conditioned to understand, that stocks kind of just go up 30% and go down 30% and that's sell. But when he spoke, he says, I'm looking at this stock and it's going to go up 100%, 200%. And this was like beyond my, my blinkers that I'd been looking at. So I went back, I reproofed it, and to the best of my ability. And I just thought, wow, this is amazing, but will it happen? And so I invested a little bit, and one of these stocks was called Rain Industries. And Rain Industries makes carbon anodes for the aluminium business. It was valued at around 35 to 50 rupees for about 5 years. So just bobbing around, let's say, break up distressed values. And initially he said, okay, invest, and it'll go to 120 rupees. And I said, okay, I'll invest. Then when I hit 100, I said, what do I do? He goes, it'll go to 300 rupees. And actually it went to 470 rupees. But the entry is very important. And that was in 1 year. The entry is important, but also the exit. So 35 was never the real price, and 470 was never the real price. So he exited, he said exit at 300, and that's what I did. And from that 470, it actually fell back to 100. And actually during March 20, it went to around 50. So the entry is very important. The exit is also as important, when to sell and not be greedy. So then I was just saying, then he said, okay, then I used to meet him quite often, and I used to pick his brains and say, how do you do this? What do you do? How do you manage? Because there's both an art and a craft in investing. So everyone can do the craft. There are a lot of CFAs, MBAs, ACAs, anything with A seems to be pretty decent in finance. But how do you make yourself, let's say, create a bit of alpha? So that is also the art of dealing with the market, looking at relative value, looking at inefficiencies, picking a theme, building up a portfolio construct. So all these things are very important. So I used to really just pick his brain. How do I do this? How do I do this? And he was really nice and very, very, let's say, open, which a lot of people aren't. And eventually he said, why don't we start something? He was running his own book. So back in 2018, we started First Water, essentially. So essentially, we got a big four to review his track record, because obviously we wanted to substantiate our claims that we're a decent fund. And they showed that he took $3.15 million investing in India to $174 million in a 15-year period. So that's a dollar CAGR of 30.7%, a multiple of 55x. And as at, let's say, end of June 2021, that was around over $300 million. So that's pretty decent in terms of 100x, and it's organic. And very fortunately, that track record has come into the fund.
That's fantastic. And I think, we all learn from mentors. I guess you're lucky enough to have been exposed to someone. And, one of the reasons I want to talk to you is that you've been over 2021, the fund was doing well. It was in the top 10 fairly regularly. And I'm always curious, we like to educate people, and part of this is about trying to understand where's the edge. So encouraged to hear that, you don't stick to the benchmark, that you are looking at generating alpha, moving out of comfort zones. We'll get into that. Just talk a little bit about the fund. So is it you and your partner, rough AUM, etc.?
Cool. So at this point, we're just focused on India. Well, perhaps we can take the methodology, and really it's an investment philosophy to other emerging markets, because that's where, like Indonesia or Malaysia or Vietnam, they all demonstrate the similar traits. But it very much, because we've just started, we have about 50 million under AUM. We don't want to complicate things. So India is very much our backyard and our area of, let's say, experience. We know the players, we know the rules, etc., etc. So that's where we focused on. We got about 7 people in-house. Then we've outsourced to ex-Kotak Mahindra guys a lot of the operations. They're doing a very sterling job. We have Apex as our administrators, Kotak Mahindra as our custodians, several brokers we run with. So far so good, and it's a lot of work. I get around 50 emails a day because I'm also in the ops area, and I have to delete a lot and respond a lot, and it's just a lot of work being in the.
Well, yeah, that's the less glamorous side of running a fund, but which definitely we all have to do. I mean, it's important. Okay, now let's get into the investment process, because you alluded to, the mentor, the returns that were generated, that you started this fund as a particular process, and you feel that you've got an edge over just the art of what you learn it through the books. Talk me through the investment process. How do you find your ideas? Maybe you can illustrate them with a couple of ideas.
Sure. So we're very much value guys. I mean, that's really our basis. We look at hard assets, industrials, and the reason behind this is because unless there's something wrong with the accounts, it's much easier to triangulate data. So if you look at a machine, it'll produce, for instance, 45,000 tons. This you can triangulate with its competitors. You can look at its revenues. You can also triangulate its margins. So there's a easier methodology to try and understand value. Whereas if you look at tech or finance, while a lot of people do focus on this area, but what is to say that the valuation is not led by PE inflation? So if you look at Apple of, let's say, 8 to 9 years ago, I believe its PE was around 15, and today it's 30x. So it's doubled in valuation because of perception. Whereas with industrials, that doesn't really happen as much. So this is really our kind of area. So we look at the screener. So India has around, give or take, 5,000 listed companies. So we're all listed. Then we drill down, what do we not know? So we don't really know biotech, we don't know tech, or these are not our areas of expertise, but we drill down to the areas where no one really would have a significant edge over us. Whereas in pharma or whatnot, I'm not a doctor, no one on my team's a doctor, so we don't really know about clinical trial 2, 3, 4. We're not tech guys, we don't know about the real hard AI or anything around that. But we look at things like cement, steel. So these are kind of products that you could have a pretty decent understanding of, let's say in a few days, mild steel or Portland cement, or their uses, or what are their end drivers. So you can very much learn about these industries as well as your peer set. Obviously, there's nuances that perhaps someone could do understand it better, but at least you have a basic knowledge, and that's what counts. So we drill down to our areas of understanding, the simple products, the basic products. Then we look at its what are the themes? So for instance, today, India has announced 1.5, or not today, but in the last few years, India has announced $1.5 trillion of investment in infrastructure. Obviously, if it wants to go from a 3 trillion to 5 trillion to the 5th largest to the 3rd largest, it has to have a backbone. It has to have roads, railways, ports, airports, logistics. All these need to have great efficiencies within the country. So it's announced $1.5 trillion. Also, it has to lift up the people, whether it's water, whether it's energy, lighting. All these require investment in a huge country. So who's going to build India? It can't just be one firm. So we look at those kind of firms that are still standing. So over the last 10 years, through various issues or policies, a lot of the infra firms were actually not doing too well. They were in a bit of distress. So whoever's left standing, we did a deep drill in and said, okay, who's left standing, who's still well valued, and who's going to benefit? Because $1.5 trillion is a huge amount, and it can't just go to the big guns like L&T or and so on. It's these smaller $2 to $4 to $500 million companies that will also be beneficiaries, because there's less competition and there's a huge demand from the budget. So margins will go up, revenues will go up. And because of that 10-year decade, or not 10-year, because of that long period of, let's say, infrastructure lull, they got re-rated downwards. So once there's a infrastructure, let's say, boom, they'll also benefit from the PE inflation. So not only will their revenues increase, their margins increase, but hopefully their PE will increase. So this is where you would actually identify something that would do better than the index.
Okay, so let's you get into areas that you're comfortable with and get to know. You're good at ascertaining values because you've identified the thematic drivers, you understand the competitive positioning, you've got a view in terms of what's going to happen to growth, margins, and ultimately a re-rating of the stocks. A couple of sort of follow-ups on that. Firstly, do you actually get down on the ground and go and see these companies? How do you really get to know them? And then secondly, you talked about, I guess this is one of the things about value investing, which is you could see a stock stay at, you talked about the 35 rupee company, it stayed there for 5 years. How do you identify that sort of catalyst, the tipping point, that this is the entry point to get in?
There's no entry point per se. So how do we do this? Is we stagger, because we started in 2018, and for 2 years it was a bear market. These stocks weren't going anywhere. They were actually sliding and sliding. Infrastructure projects got delayed, and so on. So it's just you just keep on staggering in, and you average into the market, because that's really your tool, your weapon against a bear market, because you are not only averaging your loss, you are also averaging your time in the market. So that's how we move in. So even if the market goes up and it still shows value, then we will stagger into the market still. So there's no one point, because if you invest all your money in one point, you're speculating that this is either the bottom or the market won't go down more than, let's say, 10 or 15%. And you're speculating that this is a one-way street, when, as you know, there's always volatility within the market.
Yeah. So that's lots of people advocate, averaging or regularly sort of adding to positions. And what about the due diligence side of things? I mean, do you meet management teams, go get yourself on the ground?
Yes. So we do pretty decent analysis. So we have a team of 3 analysts, hardcore analysts, that are specialized just on the research, and they speak to the management. We look at reports, we look at the government reports, we speak to competitors, we speak to management in other businesses within that sector. So as much research as you can do is always better, to scuttlebug, as the phrase is.
Okay, thanks. And maybe pick one name that you've invested in, just to bring it to life, this process. So walk me through a story of something that you've invested in, sort of gradually built a position in, and the reasons why you like it.
Sure. So one of our big plays is flexible packaging. So flexible packaging is BOPP, BOPET. So when you open your Walker's chips, that is wrapped in flexible packaging. When you open your Mars bar, that is also flexible packaging. So in India, it's growing at around 10 to 12%, because it's a proxy on the FMCG story. So whereas you look at the FMCG stocks, the actual producers, they are pretty well valued, 30 to sometimes 60 PE. But when you look at the flexible packaging space, sometimes you're buying it under book. You're buying it for less than the business actually cost to build. Like one of them that we've picked is Uflex. So Uflex is India's largest packaging firm. It's a true Indian multinational. So not only is it the largest in India, but it's one of the, I think it's the second largest BOPET producer in the world, including China. Yeah, and number 1 excluding China, is what I understand. And it's a true multinational, because it's not only based in India, Dubai, even Nigeria, even in America, even in Russia, I believe, or Central Europe, even in Asia. So it's a true multinational, which is something that, let's say, Indian companies haven't really been able to achieve. While there's a great export, whether it's in tech or BPO, actually having a manufacturing base overseas in other countries is something that few, let's say, sectors have done very well. And India is one of the leading countries in flexible packaging. So we identified this stock, and we have taken, let's say, a very concentrated position within the company, and we very much like the space because not only is it growing at 6% globally, it's growing at 10 to 12% in India. You can buy less than book, and there's a beautiful story here. So this is where they call it the sum of parts. So this is where India, Uflex had a very big domestic base. So it has the front end, which is the actual conversions. So this is where it produces the pouches or the end kind of products to feed into the FMCG. But it also does film. So in 2006, so the base in India was quite huge, and in 2006, it had a one line in Dubai, one line of, I believe, 32,000 tons, and as of today, it has in excess of 400,000 tons. So whereas and this is overseas 400,000. So like I said, it's in Dubai, Nigeria, America, Asia, Central Europe. So it has built this business that has grown at around a 20% CAGR in terms of both revenue and structurally in terms of from that 32,000 tons to in excess of 400,000 tons. Its EBITDA has grown from, I think, just off the top of my head. Actually, I can't quote that off the top of my head, but that has also grown at a magnificent CAGR. And because it was masked by the Indian business, that if you looked at the consolidated basis, you would see that it's growing at 15%. But now it's at such a base that the international arm is actually tilting the business in terms of its revenue growth. So suddenly it's come into its own over the last few years. And still, as I mentioned, it's less than book. It's growing at 15%, the entire company revenue-wise. I mean, and its P multiple, I believe now is about 4.5, 4.8. So compare that to, the FMCG end players at 30 to 60, it's like a bargain. And why is the stock, let's say, unloved? Because it's very much a small stock. It's about $500 million. So it's under many people's radars.
Yeah.
The whole flexible packaging space is still quite small compared to some steel plants or the other heavyweight manufacturing plants. So essentially, it's also not a very, let's say, the narrative. You don't see it in the press. It's not like a sexy kind of sector, but for us, it's a beautiful sector because it's pandemic proof. In fact, there was an acceleration in terms of its utilizations due to the pandemic because more people gravitated towards packed food, clean-looking food, food from the formal process space. So actually, and also a new product line came up, PPE. So sanitizers, wrapped products had to be wrapped in flexible packaging. So all this was actually a beneficiary to the sector. And actually, back in 2000, this was a similar stock was identified where my partner, Ricky, invested in. So a similar company called Polyplex. So Polyplex is also one of the largest flexible packaging companies in India. And at that time, it was trading at 4 rupees. So in the early 2000s, it was trading at 4 rupees. And over time, he bought in. And he bought, in his own book, it represented around 1/4 of his portfolio. So that's like his conviction, that he had so much conviction that he was able to say, I like this stock, it's very reasonable, it's a holy grail. Not only does it represent value, that you could buy it less than book, but it represents growth. So it's a serial compounder over a long-term period. And actually, not only was it 25% of the book, but I understand he bought up to 23% of the company. And as of today, it's I think it's 17,000 rupees. But obviously, he didn't buy it at 4, and he doesn't have the whole amount now. So he bought up, and he's actually scaled down.
Yeah, I understand. But it's I get the point. It illustrates how you build these positions, and it's that art of identifying, good companies with good growth dynamics, but also buying them at a sensible price. Which brings us, I guess, into the sort of next question. I think it's timely. We've seen, at the start of January, the sell-off in tech, the tightening cycles really sort of coming in. And all the way through the last few years, we've been having this debate about value versus growth. But firstly, do you think, is the debate overdone? I mean, there's space for lots of styles. But I'm curious as to what your perspective is. You're clearly a value guy, but what do you think about growth?
Yeah, I mean, you can't diss it because it's done well. But I'm just more comfortable in my space because, as I mentioned, is Amazon a 60 PE? I mean, its revenue, I think, ballpark is off the top of my head, let's say 30 billion, and its valuation was, the last time I looked, 1.3 trillion, or at least now around 1 trillion. So is it worth 60x, 40x, 30x? Where do you have your conviction levels? Because, in 60 years, anything can happen. They were once the disruptors. Will they be disrupted? Anything can happen to these stocks. And, today, who's got conviction? You've seen Zoom for 75%, I think, from its highs. So, this was the stock of the pandemic, and you've just seen 75% just wiped out. So I'm just far more comfortable. As I said, with a hard asset, I can value it. I can understand it a bit more. It's very basic, and I will have more conviction if the price goes lower, because especially something like flexible packaging, as long as it's still needed, everyone says, paper or environment and all those issues, but on many fronts, it's better on a carbon basis to transport raw material and finished goods. Is more efficient. From what I understand, it needs around 8 trucks to transport the pulp for paper, compared to 1 truck to transport the raw material for PET or for PP. So from a carbon efficiency, from a durability, from a waterproofing, all these factors, of course, you've got to cut down trees. All these factors are also in the benefit, and it's cheap. For an emerging market, the guy who's just, is he more interested in the environment, or is he more interested in getting a cheap product? So for the masses, it's still, there is no substitute. Hopefully there'll be better regulation, or they'll put in better additives, so it becomes a bit more biodegradable, and we're hopeful on that. But I can have more conviction in flexible packaging than I can in a tech stock that is valued at 30 or 50 or 60x.
Yeah, no, look, so the one is driven by sentiment and a view of, you take a view of the future and what is going to succeed, etc. The other, I guess, you probably honed down on it, that I can buy this company at less than it costs them to build a factory, right? Yeah. And I'm confident in the drivers of growth, etc. So I understand what you're trying to articulate. Okay, we're coming up towards, I guess we've covered off the fun, your approach, some examples, I guess your philosophy in terms of, value. I always try and get people to share a little bit of their personal journey, the human interest side of things. And I guess my question is, is there one piece of advice or one thing that you would want to share with our audience? These are people who are learning to invest, or thinking about it, particularly with regard to Indian equities. What would your advice be?
For Indian equities, or in general, well, one is, I guess, don't give up. I mean, luck can find you at any moment. Everyone wants, or any finance guy, they dream of becoming a good investor, and sometimes you just find the right person and the right luck to take you there. Then read Benjamin Graham's book, The Intelligent Investor. I'd say that is the Bible of the investment world. Of course, it's in my space of value investing. Yeah. And India, I'd say it's our golden decade. Don't ignore it, because you know, everyone runs to safety, whether it's Europe or America, but these guys are growing at not very fast. And to beat the market, you've got to be very, let's say, sharp. You always read the stories about hedge funds can't beat the index, and these guys are smart. But in places like India and emerging markets, there's a whole bunch of inefficiencies occasionally, let's say. And the indices, because of their old economies, they have a lot of government entities. And government entities, for better or for worse, are sometimes not best valued in many perspectives. And a country like India is recognizing that, and it's starting to push a privatization program. But generally, a lot of fund managers are able to beat the index, and don't ignore India is really the message of the day.
Okay, Arun, that is great. Thank you very much for coming on to Vantage. So there you go, everyone. Indian equities, you know, potentially a golden decade ahead, worth taking a look at. I'm certainly going to be looking at some of the valuations in the smaller end of the Indian equities market. Arun Chulani, thank you very much for being on Vantage.